It's day 4 of the federal government shutdown, yet you wouldn't know it by looking at the markets. Stocks are mostly green, the broader crypto market has swelled to nearly 4.2 trillion and Bitcoin is hovering just below its all-time high. But before getting carried away by the pump, it's worth understanding why the market is rallying and what could go wrong. During the previous government shutdown, Bitcoin saw an initial pump but dumped just a few days later. So are we setting up for a similar pattern this time, or is the current setup completely different? That's exactly what we'll break down in this video. First, we will talk about what a government shutdown actually is and revisit the last few shutdowns to see how Bitcoin reacted during those times. Then we'll look at the cycle position and macro setup we had back then, compare it with today's scenario, and analyze how Bitcoin could behave this time around. If you're here for no BS, data-backed insights, make sure to smash that like button. It really helps the channel grow and keeps us driven to bring you more of these detailed breakdowns. And of course, don't forget to subscribe so you don't miss the next update. Before we dive in, a quick reminder, nothing in this video is financial advice. I'm just sharing my analysis and personal views. Always do your own research and never invest more than you can afford to lose. Now let's get straight into it. On October 1st, the United States government officially entered a shutdown after Congress failed to pass the funding bills required to keep federal operations running. These bills, known as appropriations, determine how much money each department receives for the next fiscal year. Without them, all services labeled as non-essential are legally required to stop. This time, the standoff between Republicans and Democrats centers on major spending priorities, mainly Medicaid and subsidies under the Affordable Care Act. But it's much deeper than a simple disagreement over numbers. It's a philosophical clash that reflects how divided Washington has become. The impact on the ground is immediate. Hundreds of thousands of federal workers have been furloughed, meaning they've been sent home without pay. This directly halts about a quarter of all government operations. The ripple effect spreads across the economy, delaying everything from small business loans to permits for infrastructure and energy projects. To put it in perspective, the 2018 shutdown cost the U.S. economy an estimated $11 billion, with $3 billion of that lost forever according to the Congressional Budget Office. For the markets, though, the bigger problem is the data blackout. The Labor and Commerce departments, which are responsible for publishing crucial reports like jobs data, CPI inflation, and GDP, are shut down too. With no fresh economic data coming in, the Federal Reserve loses its most important tools for decision-making. The Fed has often said its policy is data-dependent. Without that data, it can't justify aggressive rate hikes, which usually leads to a more dovish stance. Historically, that environment has been bullish for risk assets, including crypto. But beyond the short-term market reaction, the shutdown exposes a much larger truth. The traditional financial system is fragile, deeply dependent on political stability, and can be paused overnight. In contrast, Bitcoin keeps running. It doesn't close, it doesn't wait for politicians to agree, and its monetary policy can't be altered. That reliability highlights why Bitcoin exists in the first place. Every shutdown becomes a global reminder that while governments can stop working, the Bitcoin network never does. To understand how this could unfold, it's important to look back at previous shutdowns and how markets reacted. The first major one to study is the 2013 shutdown. It lasted for 16 days from October 1st to 17th, caused by a standoff over funding for the Affordable Care Act, better known as Obamacare. The macro backdrop back then was fragile. The U.S. economy was still crawling out of the 2008 financial crisis. GDP growth was weak, unemployment was high at 7.2%, and confidence was low. The shutdown itself was viewed as a self-inflicted wound that further slowed economic momentum. As for Bitcoin, this was still the early Mt. Gox era, long before institutions or mainstream investors cared about it. The market was tiny, illiquid, and dominated by retail traders and early tech enthusiasts. Hacks and exchange failures were common, with major incidents like the sheep marketplace and input-IO thefts shaking confidence. Bitcoin did see an initial pump during the shutdown, but the rally quickly faded. The volatility had more to do with the immaturity of the crypto market than the shutdown itself. Fast forward to the 2018 to 2019 shutdown, the longest in U.S. history, which lasted 35 days from December 22nd to January 25th. This time, the dispute centered on funding for the U.S.-Mexico border wall. The macro picture was very different. The economy was strong, with GDP growth near 3% and unemployment down to 3.9%. The Fed was tightening policy aggressively, raising rates throughout 2018. Meanwhile, Bitcoin was in the depths of the bear market, having fallen from 20,000 to around 3,000. The shutdown had little to no influence on crypto's direction. What actually moved markets was the Fed's shift in tone from hawkish to dovish, which sparked a strong rally in equities. The SPX jumped more than 10% during the shutdown period. The takeaway from both of these episodes is clear. The shutdown itself wasn't the key driver of market behavior. The real signals came from the broader economic context, where we were in the business cycle, where Bitcoin was in its market cycle, and what the Federal Reserve was doing with interest rates. The shutdown acted as a headline or a temporary narrative, not a fundamental catalyst. That's the framework to keep in mind now. To understand how this current shutdown might affect Bitcoin and the broader crypto market, we first need to assess the macro setup and Bitcoin's position within its own cycle. Only then can we see whether this shutdown could amplify existing momentum or trigger a reversal. This brings us to today, and the setup looks completely different from both 2013 and 2018. The current macro environment is unlike anything we've seen in recent history. Instead of a fragile post-crisis recovery like in 2013 or the strong expansion of 2018, 2025 is shaping up to be a year defined by slowing global growth and stubbornly high inflation. This mix of weak growth and persistent inflation creates a stagflationary backdrop, one of the toughest scenarios for policymakers and investors alike. It limits the ability of central banks to cut rates without risking another inflation spike, while economic momentum continues to fade. The political landscape adds another layer of uncertainty. The current level of polarization is far deeper than what we saw during earlier shutdowns. Movements like Project 2025 show that this isn't just a fight over short-term budget priorities, but a clash of visions over the government's long-term role and structure. Previous shutdowns were driven by policy disagreements that eventually found compromise. Today's tone is far more rigid, with both sides framing it as a zero-sum power struggle rather than a negotiation. There is still a chance this issue gets resolved within a week or two, which would be the ideal scenario. Markets would likely stabilize, and Bitcoin could continue its push into price discovery. That outcome would also support a strong final quarter for altcoins, with the cycle playing out as many expect. However, the risk of a prolonged shutdown is noticeably higher this time. If that happens, the shock could spill over into equities and risk assets broadly, creating turbulence even within the crypto market. A shutdown that lasts for weeks can quickly move from being a temporary market disruption to a genuine crisis of confidence in U.S. governance, and by extension, the full faith and credit of the U.S. dollar. This could drag equities down, and if stocks start plummeting due to this political drama, Bitcoin and crypto will most likely follow and dump harder. During this period, Bitcoin dominance has been rising as Bitcoin rallied from 113K to its current levels near all-time highs. This shows that the market has been shifting to the safest asset in crypto during uncertain times. If the shutdown extends and markets nosedive, there is a high probability that Bitcoin dominance breaks above 60% and altcoins get completely wrecked. That would be the worst-case scenario, although the likelihood of a shutdown resolution within a couple of weeks remains high. We also have to recognize how much Bitcoin and the broader crypto market have evolved. In 2025, Bitcoin is no longer a niche hobbyist asset. It has grown into a multi-trillion-dollar asset class with spot ETFs approved and held by major institutions. It has become a part of the mainstream financial conversation. The idea that Bitcoin never shuts down is no longer a slogan among cypherpunks. It is now a real, widely understood value proposition that appeals to investors searching for alternatives to a system that increasingly looks broken. When we combine all these factors, we get a perfect narrative storm. A weak economic backdrop of slow growth and high inflation, a government that appears broken due to extreme polarization, and a mature, institutionally recognized asset like Bitcoin whose core thesis is being validated in real time. This mix creates a powerful feedback loop where the shutdown strengthens the Bitcoin narrative and attracts capital, pushing the price higher. As prices rise, media coverage increases, fueling even greater interest from both retail and institutions. So where does this leave us? The government shutdown is not likely to have a direct impact on the broader Bitcoin cycle. The global liquidity trends and inflation remain the primary long-term drivers. Any pump or dump caused by the shutdown is likely to be short-term and news-driven. However, this event does act as a narrative accelerator. It highlights decentralization, predictable monetary policy, and censorship resistance, exposing the fragility of the traditional system and positioning Bitcoin as a resilient alternative. When it comes to what to watch, duration is still important. A short shutdown of 1 to 2 weeks is likely just noise, while a longer shutdown could create temporary market stress. Pay attention to the rhetoric from political leaders. Are they talking about compromise or pushing for transformative agendas? The latter could prolong the short-term volatility. Finally, monitor net flows into spot Bitcoin ETFs. This shows whether institutional capital is embracing Bitcoin as a safe haven during this period. In the short term, the shutdown can create volatility and news-driven rallies or dips, but the broader cycle outcome is unlikely to change. While politicians argue, the Bitcoin network continues producing blocks every 10 minutes, unstoppable and unbothered. That is the real signal in the noise. Thank you for watching, and I'll see you in the next one.